Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Israeli airstrikes on targets across southern Lebanon kill nearly 500 people in a major escalation. One of the deadliest days of fighting in almost 2 decades between the two nations is fanning fears of an all-out war. The PBOC unveils a raft of stimulus measures, including rate cuts and liquidity support to shore up the economy. Asian stocks rally and China's 10-year yield falls to 2% for the first time on record. Plus, Nigerian billionaire Aliko Dangote tells us exclusively it is the right time to end fuel subsidies, calling them unsustainable.
Subsidy is a very sensitive issue. If, I believe the problem is not only the subsidy, it is problem that, once you are subsidizing something, then people will be blotting the numbers and government will end up paying what they are not supposed to be paying.
Well, it's just gone 8 a.m. across the Emirates, 5 a.m. over here in the UK. I'll be in London from now until the end of the week. I am Jumana Versace, and let's get you up to speed on some of these market moves before we delve into the big regional story that is playing out. But first, a quick look at these markets, because the S&P index did close once more at a record high yesterday, led by some of a rebound in some of the energy names, consumer cyclicals, and of course, digesting a lot more of the dovish speak that came through from some of those Fed speakers. We will talk more about that on the show. Today, you can see the futures are leaning towards the negative, down about 0.8%. 2-year yields also in focus. We are hovering at around 3.58. Not a lot of movement, and actually we've sort of been around 3.55 level now for about a week. 75 basis points of additional rate cuts are priced in by the end of this year. Another 200 basis points priced in by the end of next year. Cumulative 200 by the end of next year. So still does tell you that the markets have high hopes for what the Fed can deliver on in terms of rate cuts. Brent also seeing a bit of a bounce the last couple of days. We're below $75, but again up about 0.9% as the market again gets underpinned by some of the regional and geopolitical stories that are playing out in the Middle East. So again, we will talk more about what happened yesterday in just a moment. And then the CSI 300, huge moves in the Chinese index today, up 2.4%. The other major news overnight has been China announcing a huge stimulus plan, and what you are seeing is a very positive reaction in risky assets there. You're seeing it in Chinese equities, in bonds, and in some of these property stocks as well. This is the PBOC has announced that they're cutting the 7-day reverse repo rate by 20 basis points amid a slew of other measures. So we're going to talk more about that as well. But the handover from Asian stocks has been positive. Now on to our top geopolitical story. Israel has launched airstrikes on targets across southern Lebanon, killing nearly 500 people in one of the deadliest days of fighting in nearly 2 decades. The Lebanese Health Ministry says some 1,650 people were wounded in the strikes, including about 100 women and children. Israel says many of those killed were members of the Lebanese militia Hezbollah and argued that the group had placed rocket launchers in private homes. Meanwhile, U.S. President Joe Biden discussed efforts to calm tensions in the Middle East with visiting UAE President Mohammed bin Zayed (MBZ) after those Israeli strikes in Lebanon raised fears of broader war in the region. Let's bring in Paul Salem, the Vice President of International Engagement at the Middle East Institute. Paul, good morning to you. Well, it was an extremely deadly, violent day, a day of bloodshed in Lebanon yesterday, the worst day the country has seen since 2006. So many views out there about what is happening, what is going on. But let me just ask you your opinion on where you think this leads to, what happens next. And do you see the possibility of this actually evolving into a full-blown ground offensive from Israel into Lebanon?
Well, good morning, Jumana. It really was a terrible day yesterday in Lebanon. We hope the day today will not be as bad. It is causing a mass displacement of hundreds of thousands of Lebanese from the south and parts of the Bekaa Valley to points closer to Beirut and the north. As you said, the greatest loss of life since 2006, and many, many wounded. This is really part of an escalation that started last week with the pager attacks and the walkie-talkie attacks targeting Hezbollah and other assassination attacks on high Hezbollah figures by Israel. Obviously, this is in a context of almost 1 year now of Hezbollah opening a second front on October 8 last year, and Hezbollah and Israel exchanging fire. It's hard to predict what will happen in the next few days, but things look ominous. Israel, I believe, is hoping and raising the pressure on Hezbollah to try to get Hezbollah to agree to a diplomatic settlement, a ceasefire with Hezbollah, a withdrawal from Hezbollah from some of the border areas, but Hezbollah vows to fight on.
And that is the big question here, Paul, because there are serious questions about whether Hezbollah can continue to fight on. Their capabilities have been severely degraded. Many of the senior commanders have been wiped out per Israeli military yesterday. This is comments that were put out by the Israeli military. 50% of Hezbollah's infrastructure has been eliminated. Pretty much all of their senior commanders from the elite Radwan fighting force have also been or thought to have been killed. What does this mean for Hezbollah's capabilities and future ability to engage in a viable war at this point?
Well, Hezbollah can continue to launch missiles and drones into Israel. It has an enormous stockpile. It has definitely been greatly degraded over the last weeks and the last year, but it has such an enormous stockpile. Keep in mind that it has a direct route of contact and resupply through Syria to Iran. Unlike Hamas in the Gaza Strip, it is not besieged, it is not isolated. So yes, they are very much degraded, but also yes, they can continue to fire dozens or hundreds probably of missiles, as they are doing on and off on a daily basis. Israel is relying on its Iron Dome and its defenses, but some missiles are falling in Israel and injuring. Hezbollah is certainly degraded in its ability to resist a land incursion if Israel would choose to do that.
One of the other questions people are asking is, where is Iran in all of this? And we know that Hezbollah gets a lot of its military funding, its training, financial support from Iran. And yet, yesterday, the Iranian president, Pezeshkian, was paying his first visit to the U.S. He spoke to reporters outside the UN General Assembly, and he said, we're willing to put all our weapons aside so long as Israel is willing to do the same. This doesn't sound like Iran is going to show up in a meaningful capacity to provide Hezbollah with the support it needs right now.
Well, a couple of things. I mean, President Pezeshkian doesn't really speak for the IRGC or the hard side of Iranian power. It's often the case in Iran that they send soft messages in one area and hard messages in another. But it's also true that Iran does not want Hezbollah to go into an all-out war with Israel. It wants to preserve Hezbollah as a long-term deterrent for Iran itself, not for Hamas or anything related to the Palestinian issue. So I think it's trying to calm the situation, de-escalate the situation. I doubt very much that they would join any escalation of fighting between Israel and Hezbollah. I think they will keep their powder dry and to avoid being dragged into it, although they would certainly try to resupply and support Hezbollah.
What is the likelihood, Paul, of this eventually leading to some form of Resolution 1701? For viewers not familiar with it, that's the resolution that was introduced after the Lebanon-Israel 2006 war, which stipulated that Hezbollah have to put down their arms and retreat away from the border. How likely is it that this all culminates with some form of 1701 actually being implemented this time?
Well, I think in the near term, it's unlikely. Hezbollah, backed by Iran, has said that they will accept a ceasefire and potentially new security arrangements across the border if and when Israel and Hamas get to a ceasefire agreement in Gaza, and that doesn't seem to be happening anytime soon. Israel is trying to raise the pressure on Hezbollah to make it unpalatable for Hezbollah to see so much suffering, so much death among its own people and its own community, to force it to the negotiation table. But unfortunately, I don't think Hezbollah will be sufficiently moved by those dynamics in order to accept a full ceasefire. They might de-escalate a bit, they might hold their fire in a limited way, but I don't see a full agreement coming anytime soon. It is important to note that the Israeli envoy to Lebanon, the Syrian and the French envoy to Lebanon just arrived to Lebanon to try to negotiate something like that. And I'm sure the U.S. envoy, Amos Hochstein, will be there soon. So there is, there's potential for an agreement, but maybe a limited one.
Yeah. Paul, great to have your views on the show today. Paul Salem, Vice President of International Engagement at the Middle East Institute. Thank you. Well, on to our top market story today. China's central bank has unleashed a raft of policy support for the economy as the government makes the broadcast swing yet to hit this year's growth target of about 5%. Our chief North Asia correspondent, Stephen Engel, joins us from Shanghai. So some people are calling us a big bazooka, and certainly you're seeing quite the reaction across these risky assets today. Just break down for us what we heard from Chinese authorities and how markets have reacted to it in full.
Yeah, markets are definitely responding positively to it because if you want to call it a bazooka, it is sort of hitting the target right now, at least on multiple fronts that have suffered a lot of pain in this Chinese economy. Because a lot of people have complained that there's been piecemeal approach to, rate cuts, and also that housing rescue package didn't get a lot of traction that we had in May. So now there was a slew of different moves and a very rare press conference at 9 o'clock this morning local time with the central bank governor, with the securities regulator, one of the top financial regulators as well. So all three of them kind of on the same page talking about we need support, obviously monetary support in the tune of a new 7-day reverse repo cut. It's the second one we've had since July, on the back of a 14-day reverse repo policy rate cut we saw yesterday. Also, they're going to be cutting the RRR, the reserve ratio requirement. That's the amount of money that banks have to set aside. So they're going to cut that, get more liquidity into the Chinese economy that is obviously struggling to potentially meet that year-end goal of around 5% GDP growth. Pan Gongsheng, the PBOC governor, is saying this will inject about $142 billion of liquidity into the Chinese economy. Now, also, so you're talking about a bazooka because this was broad stimulus, very much anticipated, not necessarily expected that this would be so broad, but we also had stock stabilization moves. And Pan Gongsheng is saying they're considering a stock stabilization fund. What they also did is they are doing a swap facility that will allow securities firms, funds, and insurance companies to tap PBOC funds to buy stocks. And that's a big reason why brokerages are up and the stock indices in Hong Kong and in China are all up sharply, not to mention property stocks as well on some additional moves to shore up support for mortgages for existing homeowners.
And of course, the property sector has been a major focus from their perspective.
Yeah.
So it'll be interesting to see whether this rally actually has legs when you think about all of the headwinds that they have been facing. Our chief North Asia correspondent, Stephen Engel in Shanghai, thank you so much for bringing us the latest from China. Now, still ahead, we will get the market outlook with the UBP as traders bet on more supersized rate cuts by the Fed before year-end. This is Bloomberg.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.
Momentous as the recent decision to begin removing restriction from monetary policy was, taking that step does not lock us in a cadence for further moves. I think it's important that no one think that we're in a mad dash to get to some neutral level. Given the amount of uncertainty in the economy, being more patient will be valuable.
That was Atlanta Fed President Raphael Bostic and Chicago Fed President Austin Goolsbee with contrasting views on the Fed's rate path. With Fed officials leaving the door open to more jumbo rate cuts, traders are pricing in about 75 basis points more policy easing by year end. Let's bring in Eleanor Taylor Jolidon, a co-head of Swiss and global equity at Bancaire Privée, so UBP. Good morning to you. Great to have you with us on the show, listening to all of the Fed speakers who now actually are coming out in force now that the decision has taken place. And the takeaway here is it feels as though there are going to be plenty more rate cuts to come. The question is, are they going to be as much as the market is pricing in? Because the market cumulatively is pricing in 200 basis points by the end of 2025.
Well, the market is not noted for being right in its timing, at least in short-term timing. And remember that it's not that many months ago that we were expecting to have, 4 cuts during 2024, starting in March 2024, yes, starting in March 2024. So what I find interesting about the Fed language is that it does leave a lot of paths open to them. And we've seen a very big move, surprisingly big move, which was clearly signaled about a week or 10 days prior to the announcement last week. So they want the market to understand what they are doing. And I expect that we're going to continue to have clear signaling going forward. And certainly I would not expect that we should push or be granted everything that we wish. And if we all think, oh, they're doing 50 basis points cuts regularly, we may see disappointment further out. I think this is still going to be very data dependent. That's the message we're getting from the Fed. And even if markets do tend to prefer rate cuts to rate hikes, that doesn't mean that the market will get exactly the calendar they're hoping for.
One of the headwinds that people have been talking about to markets and the direction of travel from here is some of the weaker signals coming through from China. But of course, we were just speaking to my colleague in Shanghai about the slew of measures put forward by the authorities this morning. To what extent do you think that can help propel global markets higher now that some of those headwinds arguably have subsided?
Well, intervention is something that central banking authorities, that fiscal authorities have been using for a long time in history, and perhaps have been using to a greater extent, notably in the West, since the great financial crisis. It is not surprising when you see the weakness of the Chinese economy that there have been decisions there too to intervene. And indeed, the interventions are a little bit more than the market was expecting. But I think it's also a reminder that China is a fairly mature market now, and you can make very large interventions, which is what I would qualify these interventions as being, without it necessarily having a massive difference. And I think that's what you're seeing on equity markets this morning, that yes, equity markets are well-oriented, that they're not exactly exploding. And there are still a lot of questions around consumption, and certainly what kind of consumption, what direction consumption in China is going to take. So good to see an intervention happening, but don't expect miracles. This is a market which is also maturing and therefore is likely to grow at a lower pace. This means that we all need to think a little bit more about growth in our own markets and together in order to ensure that we continue to have a growth path, but that might be more modest than we've been used to.
Yeah, one of the big features of the market the last few weeks has been that rotation trade out of cyclicals into defensives. And I just wonder, with, again, some of the stimulus measures coming through and some of the perhaps not as bad signals coming through from the U.S. economy, even though the Fed has started to cut interest rates, whether that rotation trade could actually be at risk, or whether you would favor deploying money into defensives looking ahead.
A part of that defensive rotation is probably linked to the movement on rates, that some defensive stocks are often considered as bond proxies. So as you see rates come down, there may be a growing interest for some of those defensive stocks. But the other point is that the consumer is not particularly strong in Western economies. It continues to be searching for new avenues in China, and that doesn't make necessarily consumer-facing defensive stocks particularly attractive at this time. On the other hand, you do have some cyclicals, which clearly have not performed particularly favorably so far this year, despite seeing a stronger economy in the first half of the year. That may have meant that some of them have been over earnings first half, and that might mean that the second half is weaker than what they've been set up to be.
Yeah. Eleanor Taylor Jolidon, great to chat to you as always, co-head of Swiss and Global Equity at UBP. Thank you. Well, coming up, Boeing makes its latest and final offer to striking workers. More details next. This is Bloomberg. Boeing has offered striking workers a 30% pay bump over the next 4 years. That is up from 25% increase, which was rejected earlier this month by 33,000 members of the International Association of Machinists and Aerospace Workers. So for more on this, Bloomberg's aviation reporter Danny Lee joins me now. Well, Danny, we have seen a flurry of comments from Boeing and its union overnight, and it seems as though this is a take it or leave it offer. So just break it all down for us.
Yeah, I mean, Boeing offering 30% as part of this pay raise is an improved offer, but given how many union members rejected the original offer, this doesn't seem to go far enough to the original demand of 40% pay rise. Boeing have offered other incremental improvements, including restoring the annual bonus that it originally taken away in the first settlement, but clearly this has angered the union because Boeing has gone directly to members effectively and has demanded a vote by September 27th. And the union is saying, no way, we are not voting on this, and this is still an offer that does not meet the needs of its union members.
Danny, so what happens now? I mean, the two sides still seem to be very far apart. The union members are not happy. Boeing are saying it's take it or leave it offer. So what happens now?
Yeah, frankly, I think this deal is worse than the first one, even though there are improvements. It's just the way in which Boeing has conducted itself. The union feel that it has been disrespected, and the union leadership hasn't been consulted on the offer. So therefore, I feel for Boeing, it's going to have to come up with something even more. And obviously for Kelly Ottberg, the new CEO, whether he's conducting this strategy deliberately, clearly Boeing are going to have to offer a lot more, or this strike will just drag on, and this will cost Boeing even more money.
Yeah, it appears to be the case. And of course, another issue that is facing Boeing at this point. Bloomberg's aviation reporter, Danny Lee, thank you so much. Well, coming up, commodities rally as China announces a raft of measures to help the economy. We'll have all the analysis next on what China's stimulus measures mean for commodities and more. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Israeli airstrikes on targets across southern Lebanon kill nearly 500 people in a major escalation. One of the deadliest days of fighting in almost 2 decades between the two nations is fanning fears of an all-out war. The PBOC unveils a raft of stimulus measures, including rate cuts and liquidity support to shore up the economy. Asian stocks rally and China's 10-year yield falls to 2% for the first time on record. Plus, Nigerian billionaire Aliko Dangote tells us exclusively it is the right time to end fuel subsidies, calling them unsustainable.
Subsidy is a very sensitive issue. If, I believe the problem is not only the subsidy, it is problem that, once you are subsidizing something, then people will be blotting the numbers, and government will end up paying what they are not supposed to be paying.
Well, it's just gone 8:30 a.m. across the Emirates. It is 5:30 a.m. in the UK. I'm Jumana Bersachi in London this week. A quick check on markets for you. S&P did end once more at all-time record highs. Today, the futures are leaning slightly towards the red, but marginally so. The point is, markets have been going from strength to strength since that Fed rate cut last week. Two-year yield sitting at around 3.58%. We have got another 75 basis points of cuts priced in by the end of this year, 200 cumulative by the end of next year, again, as the markets digest a lot of the Fed speak that is coming through. Also keeping a close eye on Brent, just trading below $75 here, but still up 1% the last couple of sessions. We have seen some support come through for the energy complex. And then China very much in focus, with the CSI 300 up 2.4% after Chinese authorities unleashed a wave of stimulus measures, both liquidity and on the rate front, and some technical measures as well that would enable financial institutions to buy stocks and bonds in an easier fashion. So all of that has meant a risk-on rally for Chinese assets this morning. But we are getting some breaking news now from the RBA. If you thought you were done with central bank decisions, well, think twice. RBA has left the cash rate at 4.35%. This was in line with market expectations. The market was not expecting the RBA to opt for a cut, given some of the inflationary pressures. But here's an interesting line from the board. They are not ruling anything in or out. And maybe some people could perceive that actually as a bit of a hawkish lean, because there is a very small member of the analyst community that think that maybe the next move from the RBA could still yet be an interest rate hike, especially because inflation remains above target, proving persistent per the commentary today. And further commentary saying that it will be some time yet before CPI is sustainably in that target range. The backdrop, though, is GDP data for the June quarter has confirmed weak growth. The outlook remains highly uncertain. But, and the RBA say this, returning CPI to target in reasonable time is the top priority. So that was a recap of the RBA here. They did not hike interest rates, have been quite hawkish on the inflation language, also saying they don't see inflation sustainably in target until 2026. So no hike, but a bit of a hawkish bias. So maybe a hawkish pause is how the market is reading it here. Aussie dollar up 0.2%. Well, commodities mostly rose after China's central bank announced sweeping measures to support the economy. Copper is up 1%, while oil is also higher on the back of the announcement and amid increased regional tensions in the Middle East. So for more on this, let's bring in Ehsan Khoman, head of Commodities, ESG and EM Research at MUFG. Maybe let's just start with the big news overnight, and that is the China stimulus that has been unveiled, because for so long that has posed a bit of a headwind to the commodities complex. We talk about it in the context of oil demand, the demand for other commodities such as iron ore, copper, and all of those have been trading in tandem with people's perceptions of how the Chinese economy is doing. Does the stimulus revealed overnight change things?
I think what was very interesting about the stimulus that was announced is that rather than spacing out multiple small easing measures, the PBOC essentially announced a multitude of measures today. And I think the most important, of course, was that 20 basis point cut in the benchmark of the 7-day reverse repo, bringing the new rate to 1.5 from 1.7. Now, of course, the net impact for us will depend on whether we see further cuts ahead or whether the PBOC now falls into a kind of a wait-and-see mode after today's policy package. Now, Joanna, for us, I think in terms of the commodities complex, I think what we would like to potentially see is a further and broadening out of the stimulus measures to potentially even to fiscal policy. And I think that's where we could potentially see more momentum driving the commodities complex higher.
We just had a board up there of iron ore, so some big moves coming in there. So anything from 2 to 4% higher. Copper also seeing a bit of love this morning as well. Do you think, to your mind, is this a function of short covering that's going through the market, positioning, repositioning, or again, do you think that this rally could actually have legs based on fundamentals that again have been revealed by the PBOC and by the announcements overnight?
So I think a couple of things. I think one, in terms of the cyclical context in today's business cycle for us really does matter. I think commodities as a broad complex do enjoy very good returns when easing cycles are good, i.e. when growth is relatively firm and there is declining inflation, which is what we're seeing in the US, which is what potentially we are also seeing now in China. And I think, historically, commodities have proven to outperform major asset classes during what we like to call soft landing episodes characterized by non-recessionary cuts, both in the Fed and now, of course, in China. And so I think notwithstanding the plethora of uncertainties in global markets today, we would recommend a more selective, a much more tactical approach to commodity investing. And of course, cyclical plays like your copper, like your iron ore, which are very China-centric, are doing well simply on the back of that.
Yeah. Let's turn to oil now. It has not been a great couple of months for the oil complex, but Brent is getting back to around $75 now. What do you put the most recent uptick down to? Is it because the Fed cut interest rates? Is it again a function of positioning, or again is it fundamentals that are driving where oil is trading right now?
Yeah, I think there's a lot of airtime given to oil's upward move on the geopolitics, and I would separate that in the sense that, look, for us, it's no barrels have been lost so far, and the conflict thus far is distant from any major regional oil infrastructure. And so we would assign that 4 or 5 leg up in Brent crude we've seen since the trough of the sub-70s, predominantly down to investors warming up to the demand side boost of Fed cuts, the weaker US dollar, which we've seen, and some reversal, as you mentioned, in terms of low speculative positioning that we are observing in the paper crude markets. Now, for us, I think the big question in crude oil markets today is at what level will prevent or potentially propel OPEC Plus from increasing or potentially lowering oil production further. And I think that's the key. I mean, they've done the 2-month extension now, but coming up towards the end of the year, I think there is a potential risk that OPEC pivots its strategy in 2025 towards its long-run equilibrium, where it's essentially strategically disciplining non-OPEC supply and, of course, fortifying the internal cohesion through ramping up barrels to the market. That's a big risk for us coming up towards the end of the year in the global oil markets.
Yeah, why would you say that is a risk, though, in the sense that they are less inclined to put oil barrels back to the market? Or where is the risk emanating from? Is it simply because they know that should they put more oil barrels to the market, that would pose more downside risk?
Well, I mean, a couple of things. One, I think in terms of the long-run equilibrium for us in terms of OPEC has been around sort of, strategically disciplining non-OPEC supply. And if we do see more, barrels to the market, there is a conceivable risk, as we've seen in the past pre-COVID, that they could ramp up, supply to essentially offset that. And then the second dimension is that, of course, different OPEC plus producers are at different phases of their production cycles and capex spend. And of course, ramping up production could potentially increase the internal cohesion that certain members of OPEC are at different stages of that cycle. And so that could balance it out. But of course, they still remain quite data dependent, and they're still quite agile in terms of their decision making, somewhat like central banks. So of course, when it comes to the end of the year, they will assess where prices are. And ultimately, it's all revenues that matter for a lot of the national oil companies. And I think that's a key focus when it comes to recalibrating what they do after that 2 months extension.
Yeah, and the cohesion factor is going to be an important one to watch within OPEC. We've also been focusing a lot on that interest rate cut that came through from the Fed and the fact that other emerging market central banks have started to ease now, not just the PBOC this morning. To what extent do you think that is going to open up commodities investing opportunities in your space?
I think very much so. I think, of course, easing supports, the demand side of the equation. And I think, we mentioned that earlier, Jumana. I think for us, it all depends about the nature of the cuts. Are they good cuts or are they bad cuts? I.e., good cuts in the sense that is growth firm, is inflation declining, or is it bad cuts where growth is essentially decelerating and there is sticky inflation? For us at the moment, certainly the camp and the gravitational tilt is much more towards good cuts. And in that sort of scenario, you'd expect commodities, particularly ones that are, helpful for emerging market exporters to do well. And for us, of course, when it comes to the commodities complex, nothing is more than a shining star when it comes to precious metals play and, of course, gold bullion. And I think the conviction view there is certainly one where all the stars are aligning going forward.
Yeah, well, Ehsan, we're quite literally leaving on a high there with gold at record highs. So there you go. Ehsan Khoman, Head of Commodities, ESG and EM Research at MUFG. Thank you very much for joining us. And coming up, Africa's richest person, Aliko Dangote, says it is time to end fuel subsidies. That exclusive conversation with the CEO and founder of Dangote Group is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in London. Nigerian billionaire Aliko Dangote says the time is right for the West African nation to end a decades-long subsidy on fuel. That's as gasoline production at his mega refinery near Lagos helps to ease pressures on the country's battered currency. Dangote told us he's aware the subsidy remains a sensitive issue.
We are Nigerians, and we have to also do something to show that, yes, we do care. And part of caring is to now agree with the government that, okay, fine, let's go ahead and do this with them, because it will be very awkward for somebody like me or our group to come and say that, no, we want to deal in, dollars. I think it's a win-win, and it will benefit the country quite a lot. The whole thing is actually, okay, fine, what do we leave as a legacy? And I think doing this, by even making sure that, yes, we've taken Nigeria out of an oil, petroleum product import country for the first time in the history of Nigeria, is a great milestone, which, I'm very, very proud about.
So how's the relationship with the government? I know there's a number of negotiations, including the price of gasoline. What kind of offering have you made?
I think we have quite a good relationship, today, with the government, and, where the president actually put the Minister of Finance and also Minister of the Coordination of the Economy, and then the Special Advisor Revenue, very smart guy, Zach Adedeji, and they are working out something which I think it will be a win-win between us and the NNPC. If NNPCs, that is Nigerian National Petroleum Corporation, if their refineries, if they start to work, then Nigeria will be one of the biggest exporters of petroleum products in Africa. In Africa, only 2 countries are self-sufficient, which is Algeria and Libya, but all other countries are importers of petroleum products.
So what kind of agreement are you expecting, actually, with NNPC?
I think the kind of agreement that we're expecting is to have a very robust agreement, where, first of all, we have energy security, where there won't be supply.
Where they give you crude.
They will give us crude.
Yeah.
Already we have agreed, like, for example, in October, they're going to give us 12 million barrels, which is averagely about 390,000 barrels a day, which will sell both gasoline, diesel, and aviation fuel. And if there's any excess, we'll export. But our refinery is also versatile, where we are producing a lot of things. It's not only these 3 things that I mentioned. We're also into polypropylene, which is petrochemical, which 80% of it is also to be exported. But 20% is what the demand is in Nigeria, which will also sell to help a lot of plastic industries. So, but with the government, I think the agreement will be that, okay, fine, when we take that one, we will now sell to everybody. So it means that 50% or 60% of our petrol stations that have not been working or they've been out of work, everybody will now be at work. Right. It will reduce the cost of having ships floating all over Lome, and, paying demurrage. Demurrage alone, we're going to save over $1 billion.
But, Aliko, there seems to be disagreements on how you price your gasoline with NNPC. Have you settled on a price? Can you give us a bit more clarity on what's going on?
Well, okay, what is going on? There was, it wasn't really a disagreement per se. NNPC bought from us this particular one on the 15th of September at the international price. which they also bought about over 800,000 metric tons of gasoline imported. So the one that they bought from us actually is cheaper than the one they are importing. And so when they announced our price, the guy, I don't know whether he was authorized or, but it wasn't really the real price. What they have announced, yes, most likely that is what it cost them, including profit, including whatever, you know, which they have never added profit to their cost. And then the other one is one that they imported, but the people don't know how much they spent in terms of the import, but their own importation one is almost maybe about 15–20% more expensive than ours. You know, so what they're supposed to do is to sell at a basket price, or if they want to remove subsidy, they can announce that they've removed subsidy, which is okay. Everybody, you know, will adjust to it.
But you're not worried, Aliko, that some of the oil majors, because of their vast resources, can sell for cheaper?
Well, yes, most likely, you know, because in business, it's, you know, I've said this in my interview before, where I said that I never knew that the oil industry mafia are stronger than the drug cartel. It's a big cartel. You know, I will say this anywhere. The issue that you are right, they can say, okay, fine, you know, to make sure that this refinery doesn't work, we'll keep selling cheaper. But right now, they won't be able to sell cheaper because they will not be able to take local currency. We will take local currency. We have the refining capacity, not only to satisfy Nigeria, we have refining capacity that is almost twice the consumption of Nigeria.
But you're also confident that you can strike a deal with authorities?
No, we will. We'll definitely strike a deal. The president has announced the...
Soon?
It's going to start 1st of October. You know, so I think between now and the next couple of days, they will come out with a very, very clean agreement.
I mean, it's a pretty big accusation that you say, you know, they're run like a cartel and they could price me out. What's your ideal scenario? So how much of the crude would you refine and sell domestically? Like, if you have a blueprint of the kind of agreement that works for you, for NNPC, and for the government, what does it look like?
Well, that agreement will look quite okay because we're going to now have a discussion with the government where we will have the one for the domestic market, which government will not give anybody $1 to go and buy. So people will now, we're going to have like a circular economy in the sense that all the transactions will remain within Nigeria, you know, bankers, letters of credit, everything will be in Naira. But the one that we're going to export, we also have our own plans to make sure that, yes, we don't fall in the hands of some of these sharks. You know, we have our own plans and we're also planning. As they are planning, we're also planning our own because we have to plan to survive, and I'm sure we'll do so.
Dangote Group Founder Chairman and CEO Aliko Dangote speaking to Bloomberg's Francine Lacroix. Well, coming up, UniCredit boosts its stake in Commerzbank, raising tensions with Germany. More details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in London. Well, diplomatic relations between Italy and Germany have been shaken after the Italian lender UniCredit moved to increase its stake in German rival Commerzbank. UniCredit has used derivatives to more than double its share of Commerzbank to 21%, making it the biggest shareholder. The German chancellor has described it as a hostile takeover, but that has been rejected by Italy. So major banking story playing out over here in Europe. UniCredit's on the offensive, looking to build up their position in Commerzbank, yesterday disclosing that they are going to be taking their stake from 9% all the way up to 21% via some of these physical options. There's a good write-up on the terminal about that. But ultimately, this is leading to some diplomatic tension between Germany and Italy, with the German chancellor saying without any cooperation, without any consultation, without any feedback, attempts are being made with unfriendly methods to aggressively acquire stakes in companies. But at this point, it just seems a big question to investors what the German government can actually do to stop this further acquisition of UniCredit stake from going ahead. So a big one for European markets. And a recap of our top Middle East story over the last 24 hours. Israel has launched airstrikes on targets across southern Lebanon and across the country, killing nearly 500 people in one of the deadliest days of fighting in nearly 2 decades. The Lebanese Health Ministry says some 1,650 people were wounded in the strikes, and out of the 492 people who were killed, 58 were women and 35 were children. Now, Israel says that many of those killed were members of the Lebanese militia Hezbollah and argued that the group had placed rocket launchers into private homes. Meanwhile, U.S. President Joe Biden discussed efforts to calm tensions in the Middle East with visiting UAE President Mohammed bin Zayed after those Israeli strikes in Lebanon raised fears of a broader war in the region. So we will keep you up to speed on all of the developments as the day progresses in what was a very violent day of airstrikes in Lebanon yesterday, the bloodiest day in the country since 2006, with no signs at this point of either side letting up. If you listen to the language out of the Israeli military, Israeli Prime Minister, in addition to some of the rhetoric that has come out of Hezbollah, at this point, the diplomacy juncture does not appear to be working. So we will be keeping a close eye and monitor developments, bring them to you. A quick look at markets before we head out for the session. As we were speaking about, S&P saw another record high in yesterday's trade. Today, futures are leaning sideways, slightly towards the red. Euro Stoxx futures very much in the green, up 0.4%. But that was Horizon's Middle East and Africa. I'm Joanna Bersecci in London. Stay with us for Daybreak Europe.